Hello and welcome to HYCM's webinar for the Foreign Exchange Week Ahead. My name is Giles Coughlin. I'm a currency analyst at forexlive.com, and I'm going to be taking you through the coming week, which we have ahead. Now, just as you have a quick look at the disclaimer, it's a really interesting week that we have ahead in the foreign exchange markets. And I'm really looking forward to this webinar because it's a really good example this week of how geopolitical situations overshadow the sort of individual currency interests of certain nations. You're going to see what I mean as we go through the webinar, and we're going to start off looking at some of those geopolitical concerns. So as we turn to the week ahead, we see here the week. I'm just going to move that slightly to the right, and we're here on Monday, August the 13th. And as you can see, Monday is quite a quiet day. But we need to recap where we are with the currency markets. I've been away for a couple of weeks, and also it's always good to look what's just happened the week before we really plunge in to what's happening the week ahead. There's one currency which has been in the headlines and you wouldn't have been able to miss if you've been following the currency markets, and that is the Turkish lira. There has been an enormous move in the Turkish lira. In fact, the Turkish lira is down around 40% this year. And as you can see, it fell around 16% on Friday before there was a little bounce into the close. It's just been on a strong advance. And many people will be thinking, well, what's actually going on with the Turkish lira? Well, the main problem with Turkey has been its current account deficit. It has to attract a lot of foreign capital in order to keep paying its debts. And that has been, relatively easy as money was being pumped in to the emerging markets, and Turkey is one of them, and particularly with the quantitative easing program that was going on with the central banks, money was freely available. However, what's happening now is that Turkey has an external financing requirement of about $218 billion, according to the Financial Times. So the next year, private non-financial institutions have got to repay about $66 billion of foreign currency. That's a huge sum. And Turkey's banks have a figure to repay of about $76 billion. Now, much of that borrowed money is foreign currency, and it's going to make it very difficult for companies to pay those bills. And the problem has been made worse by this huge currency slide that you can see here. And inflation is increasing. And what the central bank should have done is the central bank should have increased interest rates. But the Prime Minister of Turkey, Erdogan, he appointed his son-in-law to lead the central bank. And that hasn't been very successful at all. So you can see the problem that's happening here with the Turkish lira. And markets are really focusing in on this. And just out of interest, Goldman Sachs highlighted the 7.0 level. And they said that's the level at which it's serious pain for the Turkish lira. And the risk in the markets at the moment is what's going on here in the Turkish lira is going to snowball and spread to other countries. All the financial markets are interrelated. And that's the real big concern. So you would have noticed this morning that the Japanese yen, and at the end of last week, Japanese yen has been increasing. The Swiss franc has been appreciating. The US dollar has been appreciating, all safe haven currencies. So that is the big news at the moment, and one to keep your eye on, keep watching. There are opportunities with the Turkish lira. I entered a quick long at the end of Friday as Erdogan was speaking around midday. But the thing you have to be really careful of with the Turkish lira is it's a wide spread, and it's quite easy to get into hot water quite quickly if you're not very careful with your leverage. You don't just want to enter a trade without carefully planning your entries and your exits. Again, that's not advice, it's simply education. Sometimes these large political situations provide opportunities, particularly how's Erdogan going to respond. It looks like the Turkish central bank is going to have to start increasing interest rates, and when it does, that will have some kind of dampening effect on the rapid appreciation of the Turkish lira. So that's something to really look at. And as you can see, that's a geopolitical concern. And that has been affecting the Japanese yen, the Swiss franc, the US dollar. So although it's not technically on the calendar, you can see it's having a huge impact. And that's the first geopolitical concern we have. The second is, of course, China. Now, we should be more used to the China-US trade war. There's been a series of tit-for-tat retaliations between the US putting tariffs on Chinese imports, and then China responding. China been weakening their own currency, the yuan, to try to offset the impact of those tariffs. And the latest is that Donald Trump is set next month to put a further $200 billion worth of goods to be affected from Chinese imports. I think that's nearly all of China's imports with a tariff on. I think they've got about $500 billion of Chinese imports into the US. So that figure now is really, that's all their imports. So Donald Trump sent a clear message. And the thing to remind yourself with China is that what happens in China affects the Australian dollar. And the reason the two are correlated so closely is because about 30% of Australia's GDP is from exports to China. So obviously, if the Chinese economy is slowing down, then there's going to be less demand for Australian goods, and in turn, that's going to affect Australia's GDP. So one thing, if you're involved with the Australian dollar this week, have your eye on what's happening with China. Now, another geopolitical concern is what's going on with Britain. Now, with Britain, if you look at the commitment of traders reports, which comes out at the end of each week, and what I want to draw your attention to is the pound short. Now, if you notice here, the pound short is now 59,000 contracts short versus 47,000 contracts short last week. So shorts have been steadily increasing in the British pound. Now, if you look here at a graph of the commitment for traders reports, you'll see that that figure now here is now surpassing September lows from 2017. So it's nearly the lowest in a year, arguably the lowest in since March, April, about May of 2017. So there's a lot of shorts increasing. These are large hedge funds, big speculators. People are very nervous, and the reason they're nervous is, as the title of this indicates, it's Brexit focus is increasing, and that's not just our imagination. This is a graph I've got from Bloomberg, where it shows the number of newspaper stories counted for a no deal. And you can see that steadily the number of stories for a no deal has been increasing. There's about 230 odd days to go now until Brexit has to be arranged. I think it's March 2019, I think. And with negotiations really stuck in a deadlock, there really is a deadlock in British politics. There's a deadlock between Britain and EU. And so the number of news stories talking about a no-deal Brexit, a hard Brexit, is increased. And the UK government is about to outline its contingency preparations for a possible hard exit, I think in next March. And what really weighed a little bit on the pound the end of last week was the International Trade Secretary Liam Fox out of the UK suggested that there's now a 60% probability of a hard Brexit occurring. Now, whether a hard Brexit will occur or won't occur, in a sense, is a little bit immaterial at this point in time, because what we're trying to trade is the expectations. And as we look through the calendar, we're going to see that these geopolitical concerns, which I've outlined at the start of this webinar, are going to be crucial for you to interpret the economic data through these lenses. If you imagine, it's like having a pair of glasses. You know, you can put a pair of glasses on with a yellow tinge or with a pink tinge or with a blue tinge, and every time you put a different pair of glasses on, it affects how you view things. You need to have your geopolitical glasses on as you look at the economic data, which we'll be looking at. So there's a lot of implications for Britain if there is a hard Brexit, and it's expected to hit Britain's GDP quite heavily. And if a hard Brexit does materialise, then there will end up being a strong reaction in the pound and further selling in the pound in the short to medium term. So that's something to keep having your eyes open. Look out for Brexit headlines. Look out for Michel Barnier, the EU's chief negotiator with Brexit. Look for positive or negative reports from him, and particularly look at Theresa May and how she's doing it with her own parliament in the UK. There is a real risk that the prospect of a hard deal Brexit will trigger another election in the UK, and that could really have big implications for the pound. So you have to keep Brexit in focus, and I think that's pretty clear. The other event to really pay attention to is what happened out of New Zealand in last week. Now, New Zealand gave their August rate statement, and it was more dovish than was expected. They left the official cash rate unchanged at 1.75%, but they pushed back expectations for the next interest rate adjustment, and they pushed back their timing for inflation to reach the 2% target. And what you would have seen in the markets, I'll just show you here. You saw this, very quick and heavy sell-off in the New Zealand dollar. That's as a result of what the Reserve Bank of New Zealand have said in their rate statement. That is not a coincidence at all. And if you look, you can go, on their website, just go to the Reserve Bank of New Zealand, and you can go to their monetary policy, and you can click and you can read for yourself their statements. I highly recommend you do that, because you start to really, you can read this on a blog or a webinar or get it from someone else. But when you read it for yourself, that's when you internalize it, and it becomes part of your subconscious in a much more wholesome way, in my opinion. So I would encourage you to go to the central bank's websites. They've all got great websites now, relatively easy to navigate. You can get, you can listen to conferences, you can read the official cash rate statements, you can read it all online. So this is the interesting thing. They expect, we expect to keep the official cash rate at this level through 2019 and into 2020. And this is the key phrase, longer than we projected in our May statement. Okay, so that's just why I put this here. You see it's longer than they projected in their May statement. So you see they're flatlining for a little bit longer at 1.75. That was the projected rate. So now it's just slower. So now this is relatively uncomplicated, the New Zealand dollar. Yes, it is a commodity currency, so you have to be aware of that. But at the same time, this is a fundamental shift from the Bank of New Zealand, and you should be looking in the coming week for opportunities to short the New Zealand dollar. We'll have a little look at this by the end of the webinar. So we'll look at that later. I think you can see now why I started this week ahead focusing on the geopolitical concerns. They're numerous, they're wide-ranging, and they're having a serious impact in the foreign exchange markets. So with all that said, let's look at the most significant events that we're going to be dealing with in the coming week, most likely. So as Monday is a pretty quiet day, we know that we've got the Turkish lira situation materializing. The market is in a risk-off situation. That Nikkei closed down almost 2%, and risk-off sentiment is heavily in the market, so we know that. Looking on Tuesday, we have GDP data out of Germany. It's always worth looking at what happens out of Germany. It's the largest member of the European Union. So what's good for Germany is good for the EU and vice versa. So I'm not expecting anything particularly market moving. Maybe for some intraday traders, there may be some opportunities. However, that's not really the focus that you want to be focusing on Tuesday, but something to bear in mind. Then you carry on through Tuesday. And now we have the first of the major data points out of the UK. We have average earnings, excluding a bonus, claimant count change, unemployment rate, average earnings, including bonus. So the unemployment rate, we obviously want to see that if that goes down, that's bullish for the British pound. The average earnings, we want to see those to go up. So what you're looking at here is none of these data points for the pound this week are particularly going to be huge market movers for the Great British Pound. We know that the Bank of England has come out and said, look, we've increased interest rates at the last rate meeting, and we expect, they said, to increase interest rates once a year going forward. So there's nothing particular that's going to happen here that's going to necessarily be very revolutionary. So you've got to bear that in mind. There's not necessarily going to be massive fundamental shifts or changes. But with that being said, what we need to do is to start thinking when we see the results of this data released. If it comes out very bullish for the pound, say the unemployment rate drops further, something 3.9, and say average earnings increases to say 2.8, 2.9, 3%, the initial reaction is you expect to see the pound appreciate. However, given the wider picture that what you're seeing, we've got the huge Brexit concerns with the US dollar. Obviously, if this Turkish lira situation continues or gets worse, then the US dollar is going to continue to be a safe haven currency. So that could be a really good opportunity, potentially, to fade any strength of the pound. This is what's called an asymmetric risk. The risk for the pound is one-sided. It's just the risk is that it's going to be sold even on good data. Now, of course, there are exceptions though. If the data is exceptionally good, and we'll go through some of the key data points, then that might be enough to change a short or a medium term direction. But you've got to keep that in mind. So you've got to weigh what happens on Tuesday with the wider Brexit picture, and then you need to look at your time scale. So if you're looking at trading intraday, there may be some opportunities for a short, a short few points. Obviously, there's different trading styles, and maybe that's something I've maybe look at in future webinars. Look at the difference between intraday trading and then longer term trading. So longer term trading, swing traders, you might be looking to fade any beat of that data. You got the GDP out for the European Union. The big problem with the EU is their inflation. They're really struggling to see inflation translating into the Eurozone. So the ECB have said that, which what Draghi said, okay, we're going to reduce quantitative easing, but at the same time, we're not going to be increasing interest rates until the summer of 2019. The market was like, well, what does that mean? Does summer 2019 mean May, or does it mean August? When is summer? And there was the market got in the flap about what it means to be in the summer, and what language is it translated in, that kind of thing. Well, Draghi came out and said, look, summer means summer. So the plain reading of the explanation was sufficient. And we'll just have a look at the euro US dollar chart. You'll see that chart there. The euro was sold off quite heavily. There is a link with the Turkish lira with the euro, and the euro was hit. And obviously, US dollar is a safe haven currency when things get really spooked. And the Fed is going to raise interest rates on a path, rather raising interest rates two more times further this year. So any uptick in the data that comes out of the GDP for a swing trade may be a good opportunity to short. it's one to have your eyes on. Any significant change, 2.5% on the year on year, or 0.6, 0.7% will provide short-term opportunities, at least to get long on that positive sentiment for the short-term traders, and then the longer-term traders will use that to fade and to most likely get back in to the trend. Wednesday, let's see what we have on Wednesday. Again, we've got the CPI data out of the UK. We've got the now with the CPI data, okay, we've already said the banking isn't going to necessarily change its path of interest rates. But with that being said, if that CPI number really starts pushing to the upside, if you get, a year-on-year reading of, 2.93%, if you see the core, rising, 2.5%, you got the CPI year-on-year coming at 3%, then that you will see some pound strength. So you've got to keep playing these two things together. So in an ideal world, if that was obviously, for those of you who don't know, inflation is the central way a central bank controls inflation is by raising interest rates. So if inflation is increasing, if CPI is 2.9, 2.3%, then the central bank needs to control that by raising interest rates. That's the main tool, really. So CPI becomes a proxy for whether a central bank is going to raise interest rates or not. So obviously the Bank of England said we're going to do one interest rate a year. That's what they've said. So you got to translate this. So if that starts coming in 2.8, 2.9%, that comes at 3%, that comes at 2.5%, you can see, that's a sweet spot for the Bank of England. That's a really good place for them to be. And what we really want to see is the CPI data in line with the Brexit sentiment. So, and interesting is if that was a big miss, then going to the pound US dollar charts, then you can see that the pound would sell off, and may sell off quite heavily. And if you start looking at the weekly chart here, you see, look, that is looking very bearish. You've got inside bar, break of the inside bar, moving down. You have plenty of space down here for the charts to travel. So the other alternative, and you've got to always think about the other alternatives, is that if CPI is a miss, then you want to be looking at opportunities to get short. And how you enter, it depends how much of a miss it is. So if that is, if that really goes down a huge amount, if it's like 2% and then 1.7%, then that's just pretty much an instant short, because you've got the CPI data matching the Brexit sentiment. And so you've got a short-term opportunity. You can go short, take 40, 50 points out of the market. Thank you, you're done. And then you can also set orders to enter on a retrace of that move as well. So that's one to look out for. Also, the inflation report hearings, also worth looking at, potentially moving, because it gives you an indication of how the central bank is interpreting the data that's just been released and what it intends to do or not do about it. US dollar is very strong at the moment. The Fed's on a pathway to hike twice. So retail sales coming out on the Wednesday. So worth having a look at, and expected to be 0.4%. So that you may see a little bit of a dollar strength in anticipation of that meeting. So you've heard the phrase "buy the rumor, sell the fact." That may be an opportunity to buy the rumor of the 0.4% increase in retail sales. But either way, expect US dollar strength. For this to be tradable, really, you want to see quite a large deviation. Other than that, this is something just to be aware of. Thursday. Now, on Thursday, we have the Australian employment data out, and this is worth looking at because it could provide an opportunity for a trade. Although to remember, again, geopolitical concerns, the main influence on the Australian dollar over recent weeks has been the US-China trade war. And as I said, this is because China is Australia's largest trading partner, and it is the world's largest importer of commodities. So the market is expecting at the moment an employment change of about 27.3 thousand, and last month's was 50.9 thousand. So that is quite a drop from last month. The unemployment rate is expectation of 5.5%. So what you want to look at in these details is particularly the difference in the part-time employment and full-time employment. Many central banks are struggling with this. Well, many economies are struggling with the increase of full-time employment. We saw that out of Canada at the end of last week. The Canada report job numbers were great, but when you drill down to the detail, it was quite a lot of people in part-time employment. And that's part of globalization, automation. People are needing to have multiple jobs, and people work for Uber, they work for McDonald's, and they sell their, rent their apartment on Airbnb. A lot of people having to do this just to try to make ends meet. So looking at the difference between the full-time employment and part-time employment. So if the employment change is, say it's 70,000, that's great. But a lot of that is part-time employment. It's not going to have as much reaction than if the employment change, say it's 70,000 increase, and full-time, it's 65%, 65,000 of those 70,000 employment change is full-time. Wow, that's going to have much more of an impact on the Australian dollar. It can be quite a wild reading this. It can fluctuate quite a lot, but it could give you an opportunity to go long or short on the Australian dollar. But always bear in mind where we're at with the US-China trade war. And ideally, what we want the sentiments to match. That would be a good one. I will point out with the Australian dollar, just one chart. I'll just pull it up for you. Now, this is the Australian dollar, New Zealand dollar, and just slide a little template on there. What we saw here is last week saw the Australian dollar was bought up pretty heavily, and it was bought up pretty heavily because, as we've already covered, the New Zealand Central Bank of New Zealand, kept interest rates and said they're going to stay on hold for longer. Okay, there's that candle. I remember I saw it at the time. I was on holiday. I saw that and I was tempted to enter long, but Governor Orr was coming out in an hour and a half, and something else was happening. Another hour, there's a statement of Parliament, and I thought, I'm on holiday. I want to relax. I don't want to be staying up half the night for this. And I thought, I can always get long on a pullback. Now, that pullback's happened. That's quite a nice entry here. 1.1032, I think, is the daily pivot point of the Australian New Zealand dollar, and it's a 38.2 fib retracement of this overall swing. So quite a good opportunity to get potentially long. And the reason the Australian dollar's appreciated against the New Zealand dollar, it's not because the Australian dollar is particularly bullish, but it's because the New Zealand dollar is more bearish. So the chances are that Australia is going to hike before New Zealand dollar, and that's the market pricing that difference in. So you may want to consider 1.100. You could put your stops here and play up to the recent highs and beyond. So have a look. So a weak, any sort of weakness in the Australian dollar may provide opportunities to go long again on the Australian dollar, New Zealand dollar chart. So you got to interpret that when it comes. We then have going on. We're going into Friday. And Friday, we have CPI data out of Europe, the Eurozone. Now, the Eurozone is struggling with inflation. So any indication that it's starting to win the inflation battle will be positive for the euro. But, looking at the euro-US dollar, see it's being heavily sold off at the moment. So any indications that the Eurozone is failing with the increase of inflation, you're going to see weakness in the euro. So one to watch, and have a look there, have a look at the data out for core consumer price index, look very carefully at what that figure is. And if it's sort of 0.7, 0.6, you're going to see a strong sell-off in the euro, and you might want to consider what currency pair would I look at with that. Then finally, we have CPI data out of Canada, and the thing with Canada at the moment is you've got the shadow, like the economy is doing really well, and the Bank of Canada increased interest rates, and it looks like hiking interest rates at the next meeting. The jobs data out at the end of last week was, it was pretty good, but obviously that was full-time employment. It wasn't. It was part-time employment, which showed the major reason for the jobs increase out at the end of last week. So the Bank of Canada is looking good. So obviously, if there is a increase in the CPI data, 1.5%, 1.6%, you're going to see Canada strength. But what you have to remember with the Canadian dollar, and this is kind of the frustration of trading Canadian dollar at the moment, is the NAFTA deal. There's still delays over the NAFTA deals. Will it get done? Won't it get done? I think it will get done for sure, but it's the uncertainty that the market doesn't like. So those Canadian dollar longs can't really fully commit into that scenario in the ways they'd like. So just in the last part of my webinar, I just want to help you start to interpret this. So the general rule of trading is you want to pair strong currencies with, you guessed it, with weak currencies. Okay, so some interesting charts for you to watch. You've got US dollar, Japanese yen, Swiss franc. They're very strong at the moment. And I'd also put into that the Canadian dollar potentially, but you got to remember the NAFTA deal. And you got the weak currencies, New Zealand dollar, we've explained the reason why that's weaker, Australian dollar, US-China trade war, and the euro. So, interesting pairs to look at is Euro US dollar short, New Zealand US dollar short, Australian dollar Japanese yen short, New Zealand dollar Canadian dollar short. But just look out for that NAFTA situation. So I hope you begin to see, how you start putting this together. You do your analysis, you look at the geopolitical situation, you then interpret the economic data in light of that wider geopolitical scenario. You then pair strong currencies with weak currencies, and when you've done all that, you're then ready to apply your technicals. So you see, do your fundamental picture first, and then you look at the technicals and how to use them. This morning, with my role as a currency analyst for ForexLive.com, I was looking at the Australian dollar, Japanese yen short. I'm going to go through one other potential trade with you, just so you can see how this is done in real time. Oh, here we go. Okay, this is a pound US dollar short. Now, the reason this is a potential for a short trade, and the reason I've highlighted this is because of the Brexit woes. We've got a lot of key data coming out for the pound this week. So there's a high risk, as I said, risks are asymmetric. So one thing that I'll be looking at fading positive data. So if there is a slight uptick, some positive data, that could be a good opportunity to go short the pound at a better price. And we know that the market is heavily short the British pound, certainly in comparison to where it has been in the last sort of 18 months. And you've only got to look at the chart. Look, we've been in a strong downtrend. So, okay, pound US dollar looks a good potential short. So how do we apply the technical picture? Well, the technical picture is here. If you look, I have drawn a you got the inside bar, break of the inside bar, drop to the downside. Now this is on the weekly chart, this is a daily resistance level, support becomes resistance. So that level there, now you draw your swing high and your fib point down to the low, and I've already marked on here the pivot point. There is a resistance to pivot point at 1.2892. So what you start to see is areas of confluence, areas where multiple factors are joining. So we got the R2 pivot point, we've got the 38.2 fib retracement. That would be a good place to potentially go short in the pound US dollar. Again, this is not trading advice. This is education, helping you to make the decisions for yourself and just showing you the kind of ways you put your fundamentals and your technical analysis together. I hope you've enjoyed this webinar. I've enjoyed talking through this week. I've enjoyed particularly bringing your attention to the geopolitical scenario and trying to hopefully show you how to integrate that with the economic calendar that you see week to week. Next week, I'll be back again. I'm really looking forward to looking at another week ahead for you. If you have any questions, you can drop them in the box below. There is opportunity with this webinar to use the questions, and I hope that you've enjoyed this webinar. And if there's no questions, I'll give you a few moments, and then I'll hope to see you again next week on the 20th of August. Just give folks a few moments. It's funny, one of the funny things about doing the webinar is because I can't hear you guys, I can only hear myself speaking. I feel very nervous about leaving pauses, but I will leave a pause just in case someone would like to ask a question. Okay, that's great. There's no questions. And so I look forward to seeing some of you again next week on the 20th of August. Goodbye, and thank you for attending. Oh, hang on, I've just seen, oh, yeah, someone's just typed in, so I'll hang a bit longer. Oh, hi, Chandra. Thank you. I'm just saying, what we're positioned for pound US dollar. Okay, hi, Chandra. Pound US dollar. Well, we've just gone through pound US dollar. What will be the position for pound US dollar? I think what you mean by that is what levels can we likely see. The levels that you're likely going to see for the coming week are, it's going to be. So I've got to move some of that. You're going to see like about I would say about 1.3100 is likely to be the potential high, and then 1.2500 a potential low. And really, you can't predict, what exactly the levels is going to be, because it depends on the data we've seen. It depends on Brexit, but that's a rough range. If things go really positive for the pounds, you're not going to necessarily see much more upside unless it's very significant than 1.3100 area, and then 1.2500 possibly lower on the downside. So that's a question of waiting and seeing, Chandra. Okay, thanks for asking the question. Okay, you got 1.33. You got a buy position at 1.3357. Okay, let's have a look. 1.3357. Just having a look, Chandra, for you now. You've got a 1.3357. Right, now that is, Chandra, is that your target or is that your entry? Is that where you're entering long, Chandra? Or is that where you're looking to exit long? Okay, I'm going to answer your question and assume that you're looking at buying on stop at 1.3357. Now, the thing that I would say, my first observation technically, is if you're buying at 1.3357, first of all, this is a weekly chart. You're looking at price to, go through 1, 2, 3, 4, 5 weekly ranges to get there. So the only way that price is going to go from here to there is if there is some fantastic significant news. It's like, there's going to be no hard Brexit. Barnier comes out and says no hard Brexit, it's fine, we've worked out the Northern Ireland, Southern Ireland border problem, we've worked out the customs tariffs, it's all sorted. That's when you see a massive rally in the pound. And Chandra, if you saw that, you just want to enter straight in. Okay, you wouldn't want to wait until your buy stop gets hit. So your buy stop is very high up, and to be honest, it's not really the sort of trade that I'll be looking at. And also the problem is, you're looking here, you see here, I've got marked on my charts, it's a 100 moving average, right? Now, the reason I have the 100 and 200 moving average on my charts is that they're very widely followed technical indicators. And you're looking at buying just into that indicator. So, you know, you can see here, look, resistance, 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 up here, resistance. You can see that you're buying into a technical area of resistance. So that's not a great area. So Chandra, you want to go back to the drawing board and think again on that one, and particularly that, you know, that the price is so far away from where we are now. That's not a good place to really consider buying as a general rule of thumb. That wouldn't be something you'd want to be doing regularly at all. Okay, Chandra, thank you for asking your question, and that's all for now, folks, and I look forward to seeing you next week. Thank you. Goodbye.